Hi, I'm Rebecca O'Keefe, Head of Investment at Interactive Investor, and I'm here to talk about our Funds Fan pricing plan. Our Funds Fan plan is ideally suited for those investors who actually invest in funds and investment trusts, because the rate that you will pay is significantly less. It's half the rate of our standard tariff. So if you are an investor who predominantly invests in collective investments, so that is unit trusts and investment trusts, you are probably going to find yourself better off if you are on our Funds Fan plan if you trade 18 times a year or more. And if you trade twice a month or more funds, that's one buy and one sell, you end up saving £50 a year compared to our standard tariff. Our Funds Fan rate is likely to be most suitable for those who have multiple accounts across Interactive Investor, in particular SIPP accounts. Our SIPP account investments are almost half invested in unit trusts and investment trusts, with 36% of all our SIPP holdings in unit trusts and 12% invested in investment trusts. So if you are a SIPP investor, you are high on the list for people for whom the Funds Fan rate might be a better option than either of the other tariffs available. An individual fund or trust already gives you inbuilt diversification. So in theory, you are more diversified just by holding a single fund or trust than you would be from holding a single sort of share. However, there are a vast array of different investment options across the fund and trust landscape, including those who are specifically for growth or income, those who want to invest in large companies or small companies. Geographic or sector-specific funds and trusts are available. As your portfolio grows, it's likely that you will want to hold more than one or two investment trusts and funds. So from that point of view, as your wealth grows, as your portfolio grows, you may well want to consider holding more funds and trusts, and that way, hopefully, that additional diversification will actually reduce your risk overall. There are a variety of reasons why you might want to trade more than once or twice a month. They include good portfolio management. You want to be able to see whether your holdings are performing well. You only have to look at the sort of significant difference in performance between some funds and trusts across the sector to realise that there are very good investment options and ones that you would be better off avoiding. So fundamentally, that is your first starting point. But you also have investors who have ISAs and SIPPs and might be subscribing to these regularly. So they are again people for whom investing on a more regular basis makes sense. And finally, it's simply market conditions might change, or your own personal circumstances might change. You might be looking for more income compared to growth, or alternatively, market volatility may mean that you want to make a shift in your portfolio. So all of these are really good reasons why you might want to consider trading more often. We are absolutely not advocating churning your portfolio or trading too much, but what this does is it gives an alternative plan to investors who are more engaged with their holdings and want to have the option to trade at a cheaper rate.